We check in now on the latest cattle market news with our market update, brought to you by CattleFax.
Hello, I'm Marcus Brix with the CattleFax Update. In the distant past, the primary way to sell finished cattle from the feed yard was through direct negotiated trade with a packer buyer. Today, most cattle are purchased on a grid or formula base, where some cattle are negotiated in the cash market and the rest are priced off these. Year-to-date, negotiated sales volume as a percent of weekly steer and heifer slaughter is averaging 22%, right in line with the 5-year average. Cattle feeders also have a third option to establish a basis and delivery month with the packer, creating a forward contract. Formula sales that are generally negotiated 1 to 2 weeks out are used more often than forward contracting, which can be set months in advance. Forward contract delivery volume as a percent of formula price volume has averaged 18% this year. This means that over the course of 2016, formula marketed cattle have accounted for over 6 times more volume than forward contracting, some weeks as high as 13 times. Despite the big difference in volume, each pricing style has its advantages and can perform better or worse depending on the current market. In uptrending markets like 2014, forward-priced cattle tend to not capture the price increase as well as other forms of marketing. The short-term upswing is sometimes forfeited to accept a basis position, making a trade-off to lower exposure to price risk. The opposite is also true. In a downtrend like we've experienced since 2015, forward-priced cattle can perform better than negotiated or formula-priced cattle. Year-to-date, forward contract cattle have averaged 126.15 delivered, 2% higher than the formula average of 122.85 per hundredweight. 2 weeks after cash cattle lows in October, many formula contracts were being delivered against that low price, so the forward contract premium reached as high as 10%. Monitoring the spread between forward prices and formula sales can be insightful into price direction, as the forward contract premium falling can signal a trend change. In the last 6 weeks, the average forward contract price has been equal to the formula price twice and lower 3 times. This is the price behavior we would expect to see after Fed prices establish their annual lows. With Fed cattle prices now looking to trend seasonally higher into spring, keep monitoring the price spreads between the alternative marketing options. If negotiated cash prices and formula prices fail to sustain a premium over forward contract prices, then it could be an indicator of the cash market rally losing steam. For the Angus Report and CattleFax, I'm Marcus Brix.
To learn more about CattleFax, your leading source for beef industry market information, visit CattleFax.com.